Hi all, this is Akshara Menon from PMS Bazaar. Today we gather for yet another exciting Friday webinar. Also, today we celebrate the resilience, achievement, and contributions of women worldwide. Let's unite in recognizing the power of equality, fostering the world where every woman's voice is heard and valued. Today we stand together for progress, diversity, and empowerment. Happy International Women's Day to all the women out there from behalf of PMS Bazaar. With that note, I take an immense pleasure to have Ms. Sonam Srivastava as our guest for the webinar on the topic, where does the fund manager see value in today's market? Wright Research PMS is India's premium quantitative portfolio management fund. They have made tens of thousands of investors fall in love with their quantitative philosophy. Their edge lies in efficient use of factor investing, market regime modeling, using artificial intelligence in forecasting and allocation strategies. To introduce the woman behind the Wright is Sonam Srivastava. She is a globally recognized quant researcher with over 10 plus years of experience at HSBC, Edelweiss. She is an IIT Kanpur graduate who built a 350 crore plus successful advisory business using quant strategies, which she believes can revolutionize the PMS market as well. So, without any delay, I would like to give the podium to Ms. Sonam Srivastava. Before that, I would request the participants to put their questions in Q&A box and not on chat box, and not to ask any stock specific questions. Over to you, ma'am.
All right. Thanks a lot for the introduction, Akshara. And like you said, it's a very special day for us. Women's Day is when people talk a lot about women empowerment. And like Akshara said, that should be the thing that we do all along the way. It is also extremely special for me because I get to talk to the PMS Bazaar audience, which is exceptional. Last time we did a webinar, we got such an amazing response. And therefore, I am going to be doing a little bit of a product launch or a little bit of a launch today. See, a lot of you guys know about Wright Research, right? We have been working for the retail advisory market for a very long time. And it's only in the last 6 months that we have been able to launch our PMS, right? And come out to the PMS AIF audience, right? Now, for our PMS audience, we definitely want to do something special, right? There's a retail side of things, and now we have a much more premium product out there for the PMS audience, for the HNI audience. So what we are doing today is we are relaunching our PMS vertical, our whole branding for the PMS vertical as a new brand design, which is Wright Gold. So, there is the normal Wright, and then there is Wright Gold, which goes out for our premier audiences. And today's webinar will be on the gold theme, and very happy to introduce this special rebranding on this special day. Now let's try to go into the webinar, and we're talking about quant investing. And Wright Research, ever since the start, has been very, very vocal about quant investing. We do not want to be categorized as, a traditional investor at all. We are purely quantitative, and what we try to do on a regular basis is remove all human intervention and become more and more systematic, right? And we think that this philosophy has a huge benefit in India. And if you guys are like you guys follow the PMS Bazaar audience, you would see that now more and more fund managers, more and more fund houses are talking about quant. Quant itself has a lot of advantages, right? Which actually differentiate. Why do we do quant? See, I'm also investing in the same stock market. I also have a philosophy that might be based on momentum or quality or growth. But what differentiates a quant manager is that I am able to put all that philosophy into a data-driven method, into a system, and let that system be consistently guiding based on that principle. So it removes the subjectivity that a manager has, and it adds a lot of objectivity into the process. We become much more consistent in the decision making. And then we have a lot of advantages, right? We've created a system now, we can optimize it on large data sets. We work really fast because, again, it's a systematic method. And then risk management, participation, all of it is studied across scenarios and systematized, right? So while I know that momentum will work in one market, I know it will not work in another market. And I can, modify my system to work differently in another way. So, see, today's topic is definitely a little bit about quant, but also about the current market scenario, right? So, we'll start off by giving a little brief about the current market scenario. If you look at the current market, you would see in the last 1 year, we have seen some very strong rally in the market, and people are becoming a little bit skeptical right now. And that is what the flavor in the market is, right? We've seen a tremendous rally, and now we're seeing a little bit of overvaluation and worry in the market, right? So, what I'll try to do is break it down using numbers in today's presentation and help you find out where the value lies and how, as quantitative managers, we are looking for that value in this market. The first thing to see here is that we've seen a very sharp rally, and the rally has been sharper in the smaller stocks. So as you go from the largest to the smallest stocks, you will see that the smallest stocks have rallied the most over the last 1 year. And this rally has been quite exceptional. And therefore, there is a little bit of a worry towards the smaller segment in the market, that is there overvaluation there. And talking about valuation, if you look at the valuation of the large, mid, and small caps across the years, you would see, this white line talks about the small cap valuation. You see that the small cap valuation is in fact almost near the peak of 2017, right? Even large caps have rallied a lot, but they are not, they are still a little bit conservatively valued. Mid caps have also rallied a lot, and they are, not as highly valued 2017. So we are seeing the highest amount of overvaluation happen in the small and mid cap segment. If you look at, where the valuation is really increasing, as we would all recognize that the PSU segment is seeing the sharpest rally, right? And even in the PSU segment, what we are seeing is that stocks that have low free float, right? Stocks that have lesser amount of shares available to the public are seeing the sharpest growth. So this type of trend you would typically see happen when there is a little bit of froth in the market. People tend to, if you look at the markets in 2017 or 2008, you would see that was the time when the low free float market cap stocks really grew. So there is a little bit of froth there. And where does value lie in this whole picture? Obviously, PSUs with low free float have risen the most. PSUs versus all non-PSUs have risen the most. If you look at low free float non-PSUs, you will see they have rallied the least. And if you are actually going and looking out for value right now, probably that is the segment you will be finding more value. And if you are a little bit concerned about valuations, what you have to do is keep a check on your PSU exposure that is there on a very low free float companies, because that is where the wild swings could happen. Obviously, there is a little bit of worry in the market, but there is no crisis or no trigger that talks about, that there is going to be a deep correction. We are still quite healthily allocated into the market. We are very positive about the prospects, but definitely we are diversifying away towards out of the overvalued zone, and creating a much more balanced exposure, right? And talking about the balanced exposure, what we have to understand is that looking at one factor like a value or just one factor as the momentum is not how you find the best opportunities in the market, right? The markets, in fact, are made of a bunch of data points. So from the quality of earnings to the valuation of the stocks, to the momentum that they're seeing, to the risk and liquidity metrics, everything contributes to the growth of a stock or a portfolio. And that is what we try to do. What we typically would do is we would study any stock, sector, or portfolio across these multiple data points and allocate to the most suitable factor for a given scenario, right? So if you look at the performance all of these factors, you would see that maybe momentum does the best, right? In the last year, momentum was the best performing strategy. Trend following worked really well. But when momentum stops working, something else would come and support the market. And that is the philosophy that we at Right Research have, right? We are a tactical strategy that shifts between factors based on the market condition. So while till now we've had good allocation to momentum, right now we're pivoting a little bit more towards quality and value names. So this is the PMS that we offer, and you can see that we have rebranded this with a black and gold theme. If you guys go and visit our website, you will see that the whole new rebranding has happened as a premium product uh, for the PMS page. And it's happened on a very interesting day, which is Women's Day. You will see, like looking at a PMS, you will see that it has been one of the best performing PMSs out there on the PMS Bazaar website for the last few months. We've ranked in the top 10 as well, and all our funds have been top quartile, and a couple of them have always ranked in the top 10 across the past 3-4 months. We've touched a AUM of 100 crores in just 6 months of being live in the market. We've delivered amazing returns. And this is on back of the excellent work we've been doing on the advisory side. On the advisory side, we in fact have 500 crore plus AU asset under advisory that we manage. What you will see is that our factor fund has stayed robust, not just in the good times, but also in a month like February, where you saw sufficient amount of volatility, right? So even then, the strategy has been quite robust. The differentiation for Right Research is that we are purely systematic, and if you put your philosophy into a system, what system gives you an opportunity to do is optimize various aspects of it using statistics, AI, and machine learning. So that is what we do at Right Research. Like I said, I really like the momentum investing strategy. It works really well across different scenarios. But then there are markets when momentum does not well, where you have to go and look at value, where you have to go and look at quality. And that is what our AI model enables us to do. Our AI model forecasts the regime in the market. Sometimes the market says, okay, it's a high risk market, so we will play it safe. When the model says it's a good market, then we'll allocate more towards momentum and small and mid cap stocks. Right now, our system is hinting at caution. So therefore, you are seeing a little bit of pivot happening towards slightly safer quality and value names. These are the three funds that we offer at Right Research. Our factor fund has been ranking on the top of PMS Bazaar for a while. It is a multiple factor strategy. Then I have the factor hedge. This is more of a momentum strategy that we also hedge. So it is mostly momentum investing with hedging. It has 20 stocks. Then I have the alpha fund, which is extremely popular, but this is a high risk strategy, right? So here I'm only investing into 10 stocks, high momentum. And what you will see is that this strategy has seen a sharper correction in February because it is a high risk strategy. So obviously, the correction here was a little bit more sharp. As for the factor fund, see, this is a back-tested study. It's purely systematic. And see, the benefit with Right Research, and what I'm really proud of what we do is that our performance always matches our back test, right? And that is the core of quant investing, right? I am coming to you with a system, and only if my real performance matches my system will I be adding value. And that is what happens. And that is why we are happy to share backtested performance. Obviously, you have to understand backtest or backtest. But our philosophy, if you apply it over a 10-year horizon like we have done here, we expect a very good return out of the market. But what is very notable here is that it's not just high returns, it is also high returns at a low risk. And that is the core of our philosophy. Everything that we are doing, identifying factors, identifying risk regimes, everything is done so that I can be consistent, right? This whole system, could deliver much higher returns if we didn't care about risk. But because we're extremely risk aware, you will see our risk always slightly lower than the market. Therefore, you will see a much more smoother return profile coming out of our portfolios. Talking about risk, we have a couple of scenarios. You will see that 2020 and 2021-22, both of these scenarios, our strategy did much better than the market when there was a higher risk in the markets, right? And now talking about the current scenario, right? We talked about, where we are seeing overvaluation and where the worry is. Let's talk about where we are allocating right now, right? So if you look at the current allocation of the strategy, you will see that allocation has shifted more towards large caps in comparison to mid and small caps. I remember when we talked to PMS Bazaar last time, our small and mid cap exposure was much larger. Right now, we're seeing more exposure shifting toward large caps. Here again, some of the small and mid caps that we held before have actually grown so much that they've become large caps. But the new allocation that has come in has actually come into the large cap segment. In our momentum fund, right, which is the high momentum fund, the hedge version, there what we've seen is stocks like TCS, Reliance also get allocation, which is quite surprising given that those are massive large cap stocks, right? In our strategy, what you will see is right now we also have a small amount of exposure to gold, which has been working very well in the last 1 month. If you talk about factors, right? So I keep on talking about factors. So what are the factors where the multi-factor strategy is allocating to? You will see that definitely momentum is the best performing factor in India, and we do have sufficient allocation there. But along with momentum, we are also allocating to value and quality in the current market. In terms of our stock allocation, you will see that it is quite diversified. We have, finance and banking do hold significant portions in our portfolio, but along with it, you will see pharmaceutical, hospitals, engineering, auto ancillary, cements, a little bit of oil and gas, metals holding allocation. So it's a very well diversified allocation. We have cut down on some of the frothy names, right? So we did have allocation to railways and defense. We have cut down in the past few months. And right now it's quite diversified and prepared for any volatility that might come into the market. In terms of our largest holdings, these are our largest holdings. So, you will see instead of PSUs, now MNCs have more allocation in our portfolio. And again, the tilt is toward infrastructure. So Cummins India, Dixon, Indian Oil, Nippon, AMC, and LIC are some of the largest holdings that we have in our PMS. Talking about trying to bring in this presentation to the close, let me now quickly talk about where actually are we seeing value and where actually are we seeing quality in the current market. So what we did an analysis of our factors and what are the segments where we are seeing significant value right now. So right now, banking and finance, mining and minerals, and oil and gas are some of the buckets where we are seeing good value. And that is where the allocation is slowly shifting. If you look at quality, you would see that the consumer side of things, metals, IT, and refineries are certain segments where we're seeing good quality right now. In terms of momentum, we are seeing again banking, finance, pharma, cement being the big picks in terms of momentum. So that is a quick presentation from my side talking about our quantitative philosophy, where we are investing and where we are actually seeing value in the current market. If you are interested, please go out to our website and please check out our rebranded website, which we have just launched, and let us know what you think. With that, I'll hand it over to you, Akshara, and let's go to the Q&A.
So thank you for this quick PPT. So today we have a lot of time for this Q&A session. So don't really let me take the very first question from the audience itself, and then I'll. The very first question was like, is momentum too risky versus fundamental investing?
Right. See, I think Momentum definitely has risk, but it's not like fundamental investing does not have risk. Sometimes value investing would have more volatility in comparison to momentum, right? So momentum, you would see more sharper moves, but in the long term, your risk might end up being similar to what you're getting from the market or slightly higher. But it's not like, a fundamental investor will not have a risk, right? They would also have a similar risk in comparison to momentum investing.
Okay. Actually, let me start with the very same question. Like, what is your outlook on market performance leading up to, and how do you see elections affecting the market? How the most anticipated market movement is on elections. So how do you
Yes.
see that, ma'am?
Yeah, I think, see, election is a massive event. There is a lot of speculation, in the market on what's going to happen, but we will see how things unfold as it goes. What we have done, Akshara, is we've done an analysis of different sectors and industries across previous elections. What we see is that elections end up not having a major impact on the market, but typically small and mid caps have a little bit of they lag before the elections typically, which is what we are seeing right now also. So we are being a little bit safe in that sense. What we typically also see is PSUs rally before an election, which has happened. And right now we are a little bit concerned about that froth. Uh, but yes, in the run to the elections, what makes sense to us is to go a little bit safer, right? So that's why you can see our allocation more towards large caps, more towards, large float, non-PSU stocks, and, highly diversified.
Okay. And I'll let you move to the next question. What is the difference between Wright PMS and Wright Gold? Same one with new branding? I think this is a common question everyone would have.
No, no, yeah, yeah. So Right Gold is like a rebranding of the PMS experience, right? Right PMS. So like, see, the analogy is Zomato and Zomato Gold, right? So there is the right research and then this right gold for the premium customers.
Okay.
Yeah.
So when you say you rebalance your portfolio, so if an investor enter portfolio 6 months back, and the investor who enter 6 months later, so what difference can these two investors see?
No, so definitely, if you talk about our case, if you invested 6 months ago, you would have definitely have seen, 50% odd returns, right? Like our strategy has given. But right now, obviously, there is a little bit of a volatility that has creeped in, right? And returns might be a little slow, uh, which is what people are anticipating. But definitely, the stocks have changed, Akshara. In the last 6 months, almost every month we've seen one or two stocks change in our portfolio, right? So the portfolio which is there right now is different from what started 6 months ago. And with our PMS, you see, the benefit is that we don't have to allocate all the money on the first go, right? For the new investors who are coming in at this point in time, Akshara, what we are doing is we are not buying into the some of the names which have become a little overvalued, right? And we are keeping that money in cash, which we are slowly allocating to the market as more allocations become clearer. We are more clearer on where we want to invest in the future. That is how we are slowly reallocating. So it's a good we do that solution also where we stagger the investment when we see volatility in the market.
Which means that you might sit on cash more when there's market being turbulent. Is that what you?
We do sit on cash for every investor, but for a new investor, right? Akshara, right now, let's say I have 10 stocks and two of them I think are overvalued, are going to go out. So what I would do is I'll only invest into the 8 stocks for the new investors, and rest of the 20% of the money is in cash, which I'm slowly allocating as our allocation become clearer.
So it depends upon investor to investor again.
It depends on the market, right? So the investor doesn't have to worry about the market condition. We are sort of modulating ourselves based on that.
Okay, well, thank you for that. And let me move on to the next question. So, of course, how do integrate the machine learning and data analytics into your quantitative approaches?
So see, machine learning, data analytics. See, data analytics is everywhere in our strategy, right? Uh, every step in the whole process, how you are ranking stocks based on a different factor, how you are normalizing that values across sector industries, how you are creating a portfolio. Everything is done using a data science based on an optimization numerical model. So it's a purely numerical method with a lot of matrix multiplication and a lot of mathematics into it. So it's a purely systematic approach that we follow. But AI is used in very few places. See, we do not let the system take the call, right? We have designed a system based on the philosophy that we believe in, right? At different places, we think AI makes more sense. So, for example, in a place where we are trying to forecast risk in the market, is it going to be a bear market or a bull market in the next month? I use a forecasting model, which I call a regime model, that forecasts the regime in the next month. Along with it, we also have we are right now experimenting with extracting sentiment and this red flags from news, right? So news is much more active in comparison to fundamental data, right? If I can identify any red flag that might come about the company from unstructured news and use that in my algos, that would be extremely important. So what we are doing, that experiment, trying to extract that information and use it in our strategy. So there are various ways in which AI is used, and our system is purely data driven. Stats is very heavily used, but AI has limited applicability, which we are also exploring readily.
So when you say the whole strategy is data driven and around machine learning, so where does the fund manager's intervention come here?
No, no. So see, fund manager, as a fund manager, I am designing the system. So I'll give you an example, Akshara. See, I'm not saying that my system is understand the market 100%, right? Nobody does. But see, recently what happened was that our system, which is highly diversified across sectors, suddenly had a little bit high exposure to PSU stocks, right? So as a fund manager, I would not go and just cut my PSU exposure and say, we are not going to invest into that anymore. What we did was we modified the system, right? In the system, we put a limit on the group level. Should we, we cannot allocate more than 25% to a PSU, to a Reliance group, to a Tata group. And then we analyzed the system across history and saw what the impact was. When we saw that, this limit is not impacting the performance, but it is reducing the risk, so we implemented that, and that is how we modified the strategy. So that is how we approach. We get an understanding from the market that this is the approach that we should follow. But it's not like we would go and just apply it. We try to modify our system, study it historically and different scenarios, and see what the impact of this change would be, and only then we go out again systematically.
Okay. Thank you for clearing that now. And the next question of Raj was that my question is how is it different from other con strategies, because everything is system driven.
Yes, so see, there are people, everybody has a framework, right? I would say, even the most fundamental, most traditional advice, investor comes with a framework, right? They have, a limit on, this much should be the earning, this much should be the P ratio, and this much should be the return on earning, etc. before they select a stock, right? That's how typically people would go. But then, most of them don't go through a totally data-driven method, right? Totally data-driven philosophy. Whereas what we do is to remove any sort of bias that could come in, right? If I am, even with all the screener and all the framework, if the end decision is based on my bias, then there is an element of subjectivity. So what we do is whatever we believe in, we put that into a system, and then we totally work on the system in optimizing it across scenarios, seeing that it is following the rules of diversification, it is booking profits when profit needs to be booked, is it shifting allocation when the market shifts, and all of that. And only then we take out that system. So ours is a purely data-driven strategy. There are other people who are doing the same thing, but again, like I said, our strategy is based on our philosophy, and somebody else's philosophy might differ. We are extremely confident about our philosophy. One, because it is multi-factor, it's not just one factor. So we're looking at various data points in the market to take decisions. It is highly risk managed, and definitely it has done well in the last 4.5 years.
So when you say it is multi-factor, so Are you focusing now on more on value investing or momentum? So, what is that one thing that you're focusing now?
No, so momentum investing, Akshara, for us gets high allocation most of the times, but right now we are seeing a little bit of a shift happening towards value and quality, right? I'm seeing quality names do extremely well, and I'm seeing high stocks that have more value do well. So therefore, our allocation is shifting a little bit towards value and quality.
So, moving forward, you can have more stocks from value. That's what you mean. Okay.
I mean,
So, what?
for some time we would see more high value and high quality names.
From CA Vidyut wants to know, like, what is your view on NBFC as a sector?
On HDFC,
NBFC.
NBFC, I think NBFC segment has gone through a little bit of a turmoil recently with all these rules from RBI come in. But I think that will be very positive in the long term. I definitely think that NBFC is a very interesting segment and we should definitely be allocated to it because you are seeing fundamental growth happening in these companies. There is a lot of reforms happening in the segment. And also, with the rate cuts as a prospect coming soon, you will see growth come back to this segment, right? Banking finance is going to get back the growth, and NBFC segment would gain a lot. So I definitely think that we should have a clear view on this segment, but we definitely have to stay safe of the stocks that are not compliant, that have certain red flags, like RBI has sort of come up with.
So, how was the risk managed in this, in the strategy? If you could explain that with an example.
See, we have very strong risk management and there are various levels to it. So, how do you manage risk in equities, Akshara? Number one, you diversify, right? You don't take too much exposure to a stock or a segment so that, when some risk comes into that segment, you get impacted a lot, right? So, we are doing that. We are diversifying a lot. Second thing is we are including multiple factors, right? See, when we talk about factor, Akshara, what you have to understand is that when momentum moves in one direction, value moves in another direction, right? So if you combine these two, you will see a much more stable allocation, right? That means you reduce the risk. So including these multiple factors, I am able to reduce the risk by including these counter forces, right? Now, the third thing that we do is that in high risk scenarios, we even add allocation to gold and bonds. Even right now, our portfolio has 5% gold, right? So allocation to gold and bonds come in when there is high risk. And then lastly, on top of everything, we are very confident of the model, but even on top of it, we have a deallocation policy. What that means is if the strategies goes more than 10% in correction, I would be reducing my equity exposure by 10%. I'll have that cash call that will keep on increasing as the correction goes on. And only after the correction is over, I'll start reallocating. So there are various levels of risk management that are built into the strategy, that actually built into the whole system, right?
Okay. So it's a long process again. And the next question from Kalpesh is that I understand that currently we have to avoid stretch small caps, but how do we know when it's time to bet on small cap again? Any triggers we can track?
No, definitely. I think there are still various pockets in the small cap universe which are doing well. Like I said, there are certain names in the PSU universe which are looking a little bit inflated, but I think after the elections, was the budget come in, and once we know, if the government announces that they're again going to give a push to railways, again going to give a push to, let's say, defense, you would see those stocks resurge again. So I'm not saying that we have to stay out of it. We have to be a little bit news driven because the critical event of this election is coming in, right?
And
Yeah.
so, like, how factor PMS is different from small case multi-factor fund offered by Wright?
Yes, so see, these are quite distinct strategies, right? PMS, like I said, we are actually managing your money end to end. So, right from rebalancing, right from trying to give you the best price, right from how we enter the market, that is something that we take care of, right? Along with it, with PMS, what happens is that, we get to take much more active calls. If I see a scenario where I think shifting a stock makes more sense today, I will do it today. Whereas with The small cases, we typically do it with a schedule at the end of the month, right? So because thousands of people actually subscribe there and they expect the email to come on a particular day. So I think those are some differences, and I think being much more active in the PMS, you get a execution preference, you get and there is an incremental performance benefit that you would receive.
Yeah. Thank you. And when we're talking about momentum hedge fund, how does momentum hedge fund identify and leverage the market momentum?
The
What?
momentum hedge fund is a purely momentum strategy. Like I said, it's very interesting right now. Our current allocation, the new stocks that have come into momentum strategy are TCS, Reliance, and I think Indigo. It has, already has allocation to some of the best performers like Zomato, Delivery, etc. Uh, and it's a very interesting strategy where we are not just looking on the price performance, Akshara. It's not just price momentum, but also forward-looking earning momentum, right? So based on how analysts are rating a stock, I include that data and how that allocation, how that estimates are changing. I use that data also in my momentum strategy. So so it is two of the best factors that we have, right? In all the factors that we have, in fact, analyzed across history, Akshara, the best performing ones are price momentum and earning momentum, and our momentum hedge is a mixture of both of these.
When you say about that, what is the optimum time to rebalance your portfolio for price momentum strategy?
Yes, I think, see, we wrote something about it in a blog post recently. If you rebalance your portfolio on a 6 monthly basis versus a quarterly basis versus a monthly basis versus a weekly basis, we see like a monthly to a quarterly is gives you a similar sort of a return. So you should at least be rebalancing on a monthly or a quarterly basis in terms of returns. But if you want to protect your risk, what we have seen is a monthly rebalance gives you a slightly lower risk, right? So for the best risk-adjusted returns, we see a monthly rebalance seems to be the optimal way.
Okay. And how does the fund identify and take advantage of market mispricing?
See, all of these factors that we are talking about are a mispricing, right? Why does momentum happen in this market? It is because people are irrational and they are mispricing. Why is there is a bias towards quality? Because that's a market anomaly that people just jump into quality stocks. Why do value stocks grow? It's an anomaly. So we look at different metrics where we can capture some sort of anomaly or some sort of a opportunity in the market, and that is the job that we have, right? That we are always looking at these pockets of opportunity or mispricings in the market and trying to allocate based on those.
Okay. And how many factors do you consider while constructing your portfolio? And what are the key factors and how do you weigh each of your factors?
Right. So see, in terms of factor groups, there are 10 broad factor groups, right? One is price momentum, one is earning momentum, one is earning quality, one is historical growth, one is risk, one is macroeconomics. Then there are certain factors that we are just researching. So let's say a sentiment or a ESG is still under research. We don't, in fact, aggressively use it. So broadly, there are 8 factor groups that we look at. Within each factor group, we are trying to identify the best way to allocate and the combination of, and there is no set, you know, percentage given to each factor. Every time we run the model gives me that, okay, today you have to have a 60% allocation to momentum and let's say a 40% to quality. Next time I run it, it might say, okay, momentum reduce the allocation to 50%, increase allocation of quality to 20%, 20% to value, right? So it shifts across time, and that is the dynamic allocation that we go with. But what we have to note, Akshara, is that even though it is dynamic, it doesn't change very rapidly. It tends to stick, right?
That's true. And the one common question I'm going to get from every other investor is that markets at all-time high. Is it right time to invest now or investors should wait? I think it's a very common question between all the investors.
No, I think Akshara, definitely there is a big opportunity for strong returns from the India market. Right? And everybody is bullish for India in the next 10 years. I think in the next couple of years, we'll see strong opportunities. I mean, towards the end of the year, the rate cut might happen, right? The growth remains strong. I think after election, we'll see a resurgence in many segments. So definitely there is a lot of opportunity, but we definitely have to be safe. Talking about safety, see, you always have to keep valuations and overvaluation in mind, but you don't have to be extremely scared, right? Because right now there is no big event that could derail the market, right? We don't see any big warning that has come up that could derail the market right now. So definitely there is a positive stance, but it never hurts to be a little bit safe, right?
That's true. So Samir wants to know, like, apart from you, who and all are there in part of your team?
So I have a very passionate team of people. I think if our any of our PMS clients are here, they must have talked to Siddharth Agarwal, who typically comes on sales calls and does operations for PMS. There is Siddesh, who joined us in the PMS operations recently. Siddharth Bhaisora, you might have seen on our YouTube, who does marketing and growth for us. And then I have a new CTO who is coming, Vinod, and in my quant research team, I have a couple of very smart IITs, Akashdeep, Sambhuti, and I have a four-odd member strong tech team as well. And you might have seen them on our social media here and there. I have a customer support, couple of people. So we have a strong 15-odd members team who are extremely passionate about what they do and
Thank
what they
you.
do. Yeah, yeah.
So if we get time, then of course we would like to get introduced to all of the team members. And moving on to the next question, how much weightage were given to fundamental when you evaluating any stock, or you only follow quant model analysis?
No, so see, even this quant model that I'm using is based on fundamentals, right? It's not just technicals, right? That is not the case. We are using, uh, you know, data from the balance sheet, data from the income statement. We are using data on forecast that analysts are making. We are using price data. We are using, you know, the trend of, let's say, fundamental data points, trend of technical data points into our analysis. So what is the weightage to fundamental and technical is a tricky question. Typically, only technical factors also get some allocation. So I would say that it might be a 50-50 between technicals and fundamental for us.
Okay, so the one common question that every other investor would have when moment you say the quant investing, how can your algo target black swan events?
Yes, see, black swan events uh, is something that are tricky, right? Like I said, that we have everything in place, but I know every year or so there will be an event that we will think that this has never happened in the world, right? Because that always happens, right? So there is no one formula. So that is why we have that deallocation policy. That if you see, let's say, a 10% correction in 2 weeks, that means that something big has happened, something unexpected has happened, and we start deallocating from the strategy and reducing the risk in that way. In one of our strategy, in actually two of our strategies which are hedged, momentum hedged and alpha hedged, what we do is that when we see the VIX level, which is the fear index, right, rise beyond a certain levels and correction also happening in our strategy, what we'll do is we'll start buying long dated put options in the market, so that if, let's say, a COVID like scenario happens suddenly, then that put option will cushion my whole exposure and reduce my drawdown, right? So we have a few checks and balances in place which will work in black swan events.
So how many stocks normally do you have in your portfolio, and what is the highest weightage, and what is the minimum weightage could be?
Yeah, so we in our factor portfolio we have around 20 stocks. In our factor hedge we have around 20 stocks. In our alpha we only have 10 stocks, right?
So alpha is more concentrated.
Alpha is highly concentrated, that's the catch.
So what for a stock? What is the highest weightage can you give?
So the highest weightage in our factor portfolio, the highest weightage is around 8%, right?
Okay,
Right
that's the
now,
highest weightage for one single stock in your
one
portfolio.
single stock, right? It can go up to 10-12%, right?
This is for alpha strategy, right?
No, no, no.
No,
For
no.
any, even in our this,
Okay.
the maximum limit we have put to 10%, right? And in alpha, we've seen stocks, obviously there are only 10 stocks. So some of the stocks have gone up to 14-15% also. But after a month we rebalance and we reduce exposure so that it is much more diversified.
Okay. So the minimum weightage would be.
Minimum weightage, we've seen 2% also go to a single stock. Yeah.
Okay. Okay. Um, So in a small case, the biggest issue was execution price. In PMS, do you make price based on execution, or these are again a market driven?
No, no. So in PMS, Akshara, right from when we started, even when we were very small, I've been using execution algorithms. So I'll give you a background about myself. I used to work in Edelweiss execution team, right, in arbitrage and execution. So I've built a lot of these TWAP, PWAP, and POV algos in my previous life. So I always execute based on these algos. Every order that we place, we slice it across time. We put limit orders. We are also experiment with different ways of execution, participating based on volume, participating based on certain other metrics. So right now we rely on broker algos that some of our broker partners have provided us, and we are also looking to build our own algos pretty soon.
Actually, what safeguards are implemented to mitigate the potential downsides in strategy driven by market momentum?
Also, what are the see what happens, if you look at our momentum strategy, what you would see, it's active, right? So every month or so you are seeing a reallocation, right? So if there is a certain event that happens to one stock or segment, we react much more quickly, right? So if you look at the return profile of our momentum stocks, you will see in the last 3 years, average upside that has happened is more than 60% in a single stock average. But the average downside is only 20%, which means that we exit stocks before, much more actively if any event like that happens, right? And being dynamic, we are if a stock goes down in momentum, it automatically comes out of my portfolio, right? So that is what the being dynamic adds to that figure.
Your Alpha Fund, is that your flagship portfolio, ma'am?
Alpha Fund, definitely it is our most loved portfolio over the last year. And definitely it is the best performing one in the last year. In February, it has seen a correction, but the nature of alpha is that it recovers faster than it goes down. So that's what we are expecting.
So that was my exact next question was like, what alpha generating strategies does this alpha fund employ to achieve its objectives?
Yes, so the alpha strategy is a concentrated momentum strategy, right? What it does, it is relies on price momentum and earning momentum, a mix of price and earning momentum, right?
Yeah.
And yeah, and I think depending on the market scenario, it would have different exposures. So like now, even that one has a little bit of a large cap exposure coming up.
Okay.
But it changes dynamically with the market, and it tends to give you accelerated returns when the markets are good. It tends to have slightly higher risk when the markets are bad. But what typically we've seen is that the moment it corrects, it recovers also very sharply.
So how has a factor fund historically fared across various market scenarios?
The factor fund, we've seen, we expect it to do good in all different scenarios, right? Bull markets, you will see momentum type allocation give you sharp returns, which we've seen in the last 6 months, Akshara. When we are in a bear market, you will see our risk management kick in, and like 2020, we had a multi-factor advisory portfolio, which only crashed 18% when the market crashed for 3%, right? So that was one good example in a bear market. Even in a sideways market like 2022, we expect the strategy to give a better return than the market. But obviously, volatility will be part of this portfolio also, because we are all in the equity markets.
So, the one question I always had was Quant is comparatively new to Indian market when compared to the global market. So where do you see the gap? Because Quant was very new strategy and it has done really well in 2020-23. So how do you see
So
that?
I think Quant does best when there is sufficient liquidity in the market, right? Because we are working with data and numbers. So now, as Indian markets are also becoming larger, much more liquid, right? We are seeing the growth of the market, and that is where Quant would start really working for India. And what you also see, Akshara, is quant in fact works better when there is more volatility. Like in a market like India, where things shift rapidly, quant works better in comparison to a market which is much more slow moving and developed, right? So I think India is a great place where quant strategy can do excellently well.
It's time for Quant to do its better performance in Indian market. That's what he meant. Thank
Yes.
you. So if I could ask, because we are on Immense Day, so I should ask this question. So if you could, just about your journey as a fund manager. So it might impress, or it can have more aspirants like us to listen to your story.
No, definitely. See, I've had a very interesting journey as a woman manager. I mean, I sort of, when I started in this field, I was actually the only woman in a whole trading floor, and I used to be very intimidated. I would, see people being very aggressive, and I used to think that I will not be able to survive here. But slowly, as I understood the nature of the market, there we are taking risk on capital, right? So sometimes things can get played up, but it's an excellent place for somebody, a woman with a positive temperament to be, and that is where I flourished. And since then, I've had opportunity to work with some amazing people. 2019, I took this step. I thought, let me start out on my own in the market because I had a lot of experience doing it for a while, and I thought, quant definitely needs to get more attention than it is getting. So let me try to do that. And it's been an amazing journey. When I started, people were not taking me very seriously because I'm a woman. I look really young. I'm not that young. But slowly, I think we've seen people really adapt to our philosophy, start trusting what we are doing, and now really allocate to it and invest into it. So it's been a very interesting journey. It's been most rewarding for me.
Yeah, true, ma'am. So your journey was very true. And when you say with relatively new to the market,
Mhm.
in terms, so how do you compare yourself with your peers?
See, see, obviously our peers have more years of being in the market, more years of track record, maybe larger client set. But what differentiates us, Akshara, is that we are small, so we work really hard, right? We want to grow, and we have to do our most. So that is one differentiating factor. Second is that being data driven, right? Being systematic. While I might not have been in the market in 2008, I can really analyze in depth on, what factors, what strategies would work in 2008 if, because I'm working with very high quality and accurate systems, right? So that gives me that edge that, even though I might not have seen that scenario, I can take the system and really optimize it for different scenarios as well, right? Which gives us much more confidence about what's going to happen in the future. And yeah, I think we work with a very positive outlook, and we're trying to get the most out of the India market, not being biased towards anything, and trying to see opportunities as they come.
Yeah, very true, ma'am. And the one question from SS was like, do you have market cap filter for your stocks? And what is the lowest market cap you pick?
Yes. So see, I think the catch with quant investing is that we only have limited data, right? I don't have for very small companies, the data is not extremely reliable, right? So the universe that we typically work with is only the top 700 odd stocks, right? So the minimum market cap that has actually come into our portfolios is close to 5,000 crores.
What is the level of churn in your portfolio? And what are the factors go into the model which change the allocation? And what is the frequency of overrides you have used? And in the model, whether the recent data is given more weight? It's from B. Manush.
Oh, wow. So lot of questions.
Yeah,
But
let me split it for you. So, but the very first part was like, what is the level of churn in your portfolio?
yeah, so the churn, see, we expect it's not a it's not a buy and hold portfolio. We do expect churn. We rebalance once a month, and we see, I would assume 200% turnover, right?
Okay. So, what are the factors to go into the model which change allocation, and what is the frequency of overrides you have used?
Yes. So see, the factors that go into allocation is number one, understanding the underlying themes, which I call factors, and then the risk scenario. If the risk is high, you will see more small caps, more high momentum stocks. The risk is, if you are in a bear market, you will see more safer stocks, large cap stock, etc. So that the risk modulation is the core thing, right? And that is what governs our allocation.
And what is the model? And in the model, whether the recent data is given more weight.
Recent data is not, see, I think some of our factors are in fact very long term, right? So, to give you an example, if I'm using a technical indicator that people can run on intraday data also, I might be using weeks worth of data, weeks worth of horizon in a technical indicator. So we typically have longer term duration factors also, but we do have smaller also. So it's a healthy mix, I would say, slightly more biased towards a longer term signals.
So let me have this as the last question for the day. So what do you mean by financial literacy for women? So what definitions according to you?
See, I think for women, uh, what we typically really lack is understanding what are the opportunities out there, right? Women typically would just sit with cash or just with FDs, but if you took a little bit of risk, right, with your investing journey, you would see enhanced returns. And that's what Akshara, you were talking about my journey. I think when did investing start clicking for me? When I understood the benefits that taking a little bit of risk does, right? All we are doing in the equity market is playing with the amount of risk, and as you understand what that risk is and the benefits that you get out of equity investing, that is when you are able to enhance your long term returns, right? So I would say that women really need to understand the benefit of adding a little bit of equity exposure to their portfolios, and saving more, and trusting the potential of long term growth by investing into the markets.
Thank you, ma'am. With that, you've come to the end of this session. Thank you for your time, and thank you for putting us a wonderful PPT to understand more about your product, and also having patience to make all the questions answered. Thank you, ma'am. Have a good day.